Hey, it's Nathan with OptionsForL.com. In this video, I'm going to go over our poor man covered call analysis tool, which is included with our pro membership. So let's go ahead and get into it. To get to it, we just go to research and PMCC analysis, and we'll walk through the steps together. So first things first, you're going to want to look up your symbol. So whatever symbol you're trying to see, if you want to do a poor man covered call for, you enter that here. I got SPY loaded up, so we'll run with that. It pulls in the latest price of SPY, and then you need to select your leap expiration. So this is a long dated expiration, 180 days plus out, and it's loading in actual expiration dates and actual prices and actual options and all that stuff. So these are realistic prices for your analysis. So I'm going to go about a year out. We'll go, January 15th is about 349 days, which is about a year. And then we select our leap call, and we're going to select one between 70 to 90 delta, and we got it from 90 all the way down to 70, so we have them filtered for you. You can also see the open interest and implied volatility as well, so that way you can make sure that there is some volume with these particular options. So I'm just going to go ahead and select one of these real quick. We'll go with the 610 strike price, and upon clicking that, you see that a whole bunch of stuff loaded up. We'll come back to it in just a second. What I want to look at first is our short call settings. So these are going to be the covered calls or poor man covered calls that we'll be selling against our long call position. So first things first, we select the expiration for our short call. Now, what you select here is important because it's going to assume that you're going to sell covered calls within the same DTE range going forward. So if you select a DTE, of 6 days, like it's going to assume you're going to be doing weekly covered calls against this position. Or if you do like 27 DTEs, then it's going to assume every month you're selling a covered call against your position and so on. So that's how it's going to calculate and project when you're going to be doing the covered call actions. I'm going to go ahead and do about a week out, so we'll do 6 DTEs, and then we can select our target delta as well. So theoretically, the lower the delta, the safer it is, but the less premium you'll receive. The higher, the more premium, but the more risk. 0.2 is a typical delta for your short call positions, but you could crank it up if you want to take on more risk, but you also face more risk of being assigned, but maybe you want to be assigned, who knows. Or you can go, all the way down to 10, which is minimal risk, but also not very much premium. So you can play with those numbers, and as you can see, when you move in the slider up and down, it adjusts the graph and adjusts the numbers down here. So it becomes very easy to go ahead and change settings around and analyze the various positions that you could go ahead and work with. I'm going to go ahead and leave it on a 0.2 delta. We can also model the in-the-money losses. We're going to come back to that in just a second here. It's a little bit more advanced of a feature, and we'll just look at what we got right now before we add more complexity to it. So here at the top, we have our leap position summary. So we got our strike price, we got our premium that we're going to pay for that position, we have our delta, and then our expiration right there. Then it gives us our premium breakdown. So here's our current intrinsic value. So that's the current price of SPY minus our long call strike price of 610, gives us about $82 per share. Our extrinsic value, or our time value, is $3,567. So there's a 30% premium that we are paying on top of our call option in order to have the right to buy SPY for $610 by January 15th, 2027. Moving on down, we have different price scenarios. So we have a few default ones like bearish, flat, moderate, bullish, but you can also add custom. And what this is aligning to is the price of the asset moving this direction and this amount in whatever amount of time. So in this case, 349 days. Where, SPY would move up 10% if you're bullish, or down 10% if you're bearish, or we have a flat scenario, a moderate scenario. But if you're like super bullish and you think it's going to go up 25% in 349 days, you could add a custom one. Or if you want to see, maybe if it has like a 20% pullback, you could add that as well and see where your profile will wind up with different price scenarios. All right, now we have a nice little chart, our elite payback timeline. So what this is mapping out is our break-even points, and it's just straight lines right here. Once we add in the money losses to it. It gets a little more curvy and stuff like that. But basically it gives us our break evens, and if we had an opportunity, let me just throw one in real quick. I'll just put it at 2000% or something like that. You can see that we could also hit our full break even point where we are covering the entire price of our option, which in this case is $11,764. Now, I don't think it's going to go up 20,000% in a year, but in some instances, different stocks have higher IVs, and you might be able to find an opportunity to have a break even for your entire debit, not just the extrinsic value that you're paying on top of it. This blue line is just your extrinsic value, so you can see where you break even on that. And there's more details down below as well, so if you can't really see what's happening on this chart, we got this summary by scenarios, and you can see it breaks down all the scenarios. So your bearish, your flat, your moderate, your bullish, and then our custom and our custom negative one that we have as well. And it goes through all the different elements. And we'll focus on the flat one right here. So this is our initial leap cost. So that's our entire debit. Again, the 11,764, 11,764. So that's what we're paying out of pocket. Then this is our short call income. So this is for selling the covered calls or short calls or poor man covered calls against our long call position. We should be able to have income of $6,811. Then we have the in the money losses. Again, we're going to come back to that in just a second. Our extrinsic break even is 26 cycles, so about 182 days or half a year. That's when we would generate enough income from selling our short calls or our poor man covered calls in order to cover that extrinsic value that we're paying, that premium on top of our call option. So that's what the extrinsic break even is. And full break even, so that would be covering the entire price of our call option. We're not going to reach it. As you can easily see from the math, like our cost is 11,764 and we're going to bring in 6,811. So yeah, we're not going to fully pay the price of our call option. Our leap intrinsic change is 0 here because we're staying flat. But if we look at the moderate, we can see that it's gone up $3,246 because if the price of SPY goes up, 5% over the 349 days, well then the price of our intrinsic value will also increase by about 5% in that same amount of time. We also have the time value decay, which is the extrinsic value that we have to pay for, and we get our net P&L, which is simply our income from selling those covered calls or short calls, plus the amount our leap position increased over that same period of time, minus the time value decay, which is our value, that premium that we paid, way up here. And that gets us to our net P&L. And then you can also see our estimated return on investment right here as well. So it breaks out all the different pricing scenarios for you. And then if we keep scrolling down, we get our projected trade cycles right here. So you can see we're on flat, but you could switch, of course, between the different pricing scenarios. And so we can see our entry, our expiration, our underlying asset, our strike price, our credit. So this is the current credit on the market. If we sold a covered call with a February 6th expiration date, and then we have our cumulative credit, so they just keep adding up. Our leap intrinsic value. So let me actually move to moderate so we can keep track of that. So again, this is where SPY is going up 5% over the 349 days, so we can track that. Then we have our theta decay, so that is the premium on the long call option that is decreasing, and then we get our net P&L. And so you can scroll through your projected trades, so you can see, entry and exit and so on, and the credits and cumulative credits and how it all adds up and when you start to break even. So right here, this is where we break even on the extrinsic value, so that covers that portion. And then we can keep going, and we're not going to generate enough credits to cover the entire price of our long call option like we've already discussed. But anyway, we can see where we get to our net P&L and everything like that. So you can check out your entire trade log right there. Now let's go back up here to the in the money losses. So model in the money losses account for cycles where short calls go in the money and need to be closed at a loss. So of course, you're not going to hit every single covered call where it expires worthless and you get to keep that credit. Sometimes, the price of the stock is going to rise too much and it's going to go past your short call strike price and you're going to have to close out for a loss or roll out and up or something like that. You're going to have to take some sort of action. So that's what this is doing here, is helping you model that type of action of not having, 100% perfection on your covered calls. So if we flip this little slider over, we have loss severity. So at a 0.2 delta, and a lot of people use delta as a percent chance of it winding up in the money. So in this case, it's a 20% chance that it'll wind up in the money. So that's why it says every 5 cycles. One of your covered calls gets modeled as in the money, and at a loss severity of 0%, you wind up breaking even at close, so you lose the credit only. So you're not going to get a credit during that round, you'll just, net to 0. And so let's take a look what happens with the numbers in the chart. So here we can see that it's not like a straight line up to the right. We have some variation here, and this is probably a more realistic flow for the types of results you could expect doing the poor man covered call strategy. And it gives you different results. So you can see that our extrinsic break even gets pushed out a little bit, and so on. And you can see the same type of results here in the trading table down below. So you can see every 5th leg we basically go negative on our credit. So instead of a positive $140 credit, we have a loss of $140. And you can see every 5th one. Let's go back up here and move up the loss severity. We'll put it at 50%. So in this case, you're going to lose your credit plus a 50% extra. So let's come on down here. So it'll be a little bit more aggressive. So this is if like your covered calls go deep in the money and you kind of hang on to them, hoping that the price drops back down. But instead it keeps going up and you wind up losing a little bit more money on your covered call position before you close it out or roll it, so you can model it in different scenarios, like worst case scenario and stuff like that. Also, if you adjust your delta, so let's move this to 0.3. So now at a 0.3 delta, every 4 cycles, one is modeled as in the money, and you can see how that impacts your profitability of your poor man covered call. And so that way you can go ahead and play with these dials, and all the charts and tables update in real time. As soon as you move them, you can see that the numbers change. So you can see like your in the money losses updates as you move this little slider over, and so on. So you can quickly see and hone in on what might be like a practical poor man covered call strategy, like where to set the deltas, how far out is the days to expiration, maybe even which leap you should select, and things like that. Now, of course, all of this is for educational purposes only. What you do is entirely 100% your responsibility. But I know that I like the poor man covered call strategy, and somebody else recommended making a tool to help model poor man covered calls, so that way they could see like if they had realistic expectations and things like that. And I think that this tool delivers upon that. So please, if you're a pro member, check it out. If you're interested in becoming a pro member, link in the description down below, or you can go to optionsforl.com and check it out over there. And that's it for this video. Hope you have a great day.